Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. All right. Well, markets are resilient, and the markets continue to go up. It doesn't seem to matter what is happening in the news nowadays. The markets just seem to shake it off and go higher. And a lot of that, I think, is driven by AI and all the deals that are being done and the possibilities that I guess people are coming around to as far as a lot of the mega cap tech stocks are concerned. The stocks that we traded or that we looked at last week are United Health, UNH, and then also Goldman Sachs. And we even looked at a VIX trade, but the VIX trade right now is just kind of stagnant at this point in time. But the VIX, we're okay as long as the market just stays a little bit higher. But I really would like to get the big spike, get the big movement to the downside. The long call position, I would think at one point in time, we talked about just buying the 18 call outright. And we are a good chunk into October. But this week, I would consider rolling that into a long call spread. These shocks to the market, like the news out of Washington about the government shutting down, stuff like that, is not created any volatility in the calendar period that usually has a lot of volatility. So I would probably sell a call against it, and I would roll it into a long call spread if that was a position that you had on, that you wanted to adjust that position. I still like our butterfly. I would even like putting it on today. I don't mind that trade at all because of where the break even is at on that butterfly on the VIX that we've talked about. But let's go in and let's review a few of the positions to start. So let's go to the Tradier Pro software. We're going to start in the what if calculator. The first trade that we have on is the time spread in Goldman Sachs. So we're going to be getting into earnings season, and Goldman is going to be announcing next week. And JP Morgan is usually the one that starts it off. There's a couple of other stragglers, but that's the big stock, and it's always the financials that kick off the quarterly earnings. So we hit our strike. So today, if we look at Goldman, we see that the stock, let me send this one to the ticket. There we are. The stock is up $6.57. Now that's less than 1%. So it's not a huge move to the upside, but the underlying stock came up and hit our strike. So what do we do with this? Ideally, because we put the position on and it moves so quickly, we put it on Friday. I think it was Friday that we put it all together. I don't remember if it was Friday or Wednesday, but we put it together on one of those days last week. And the market has now moved up to our short strike. We are profitable on the trade. And what I would do with this trade right now is just get out. You can roll the option contract. You're going to be, I think, let's see how much we're up. Yeah, we're up exactly $1 on the position. We put it on for $10 when we had the trade together. I'm pretty sure that's where that was. Yeah, I have it. I have it in my screenshot at $10, but I see the market moved a little bit on that. Market was at $7.89 when we put the trade on initially. $7.89, and we're at $7.97, right? And we're up. We can sell this thing for about $1. So what happens here? Here's the earnings. This is the week of the earnings. I think they announced on a Thursday before the open. This is the earnings report right here. So we can go look at the chart. I'm pretty sure it's Thursday. Goldman Sachs. Earnings date is on the 14th, and the 14th is a Thursday. Oh, it's a Tuesday before the open. All right. So the earnings date is the 14th. So that's the Tuesday before the open. All right. I thought it was Thursday. But if we put this trade on and we have the position and it's moved with us, and especially when it was trading for $11, you don't want the short-term option contract to get in the money. So we have 2 months here, right? this is the month that contains earnings, October 17th, and this is the week prior to it. The market has moved up to this short strike. We're up a little bit on the trade. We put the trade on for $10. It's now trading for about $11. You don't want this to get too much in the money. So if there's one of two ways to do it, either we're going to close it and take the profit. It's not as much profit as we wanted because we didn't get enough time decay on the shorter term option contract. We still have this thing trading for, $10.70 worth of intrinsic value. Even though it's only got 1 week remaining, there's just still too much juice that's in it. So if the market does, so we can either roll the whole position up and out in strike, but I would just close it at this point in time. I would take the profit and I would move on. You made 10% in 1 day. That would be my look on the trade. So we're going to officially say that we're closing it. All right. So buy to sell to open, we would be buy to close. And it won't let me hit close, but it's buy to close. And then this one would be sell to close. If you had the position on, it'll say open. 110, 1110, up about $1.10 on the trade. And that was a decent trade for 1 day to put that position on. All right. Now, we also went in on a Friday and we were busy. We looked at doing a bull call. What do we have here? We had a UNH open wing butterfly that we put on. Okay, so they got to get the strikes to the UNH one. And there they are. Okay, 335, 362, 365. Because we did get a move, so a pretty strong move to the upside in UNH. And actually, I was looking at that chart. United Healthcare. And we have earnings date coming there on the 28th. So that's happening. But if we zoom in on this chart here, we had a small breakout. We went up to 368, and now we're trading back around this level. So if we can hold right at the top of this candle, so we had one strong candle and a second strong candle, and then the next line that we're looking at is right up here, right at the 376 level. Let's look at the UNH trade and the what if calculator. 355, 362, 365, right? Expiration is the 17th. So we went a little bit in time and we see, let's send this one to the ticket. We paid $303 for it. All right, waiting for the screen to move. 1 second. Oh, got to click the buttons. There we go. That's what I didn't do. Yeah, 295, 295. I guess we're at the same price right now. We haven't really moved much. We paid $303 for it. Market was at 361. It's actually right here. So we're in the exact same spot. We should be up a little bit on it because of time decay, you would think. We were at 3 and we're a little bit down. 361.30 and we're 361.04. Even though we had the run up, we came back. We've given it back. So the position will just stay on. We're looking for time decay to help us out. See where the market's just moving back and forth. Let me pull this down a little bit. And we're at 361.10. This is where our precipice is on the top of our butterfly as we climb the mountain if we continue on up. So I still like where the chart is at. I still like this trade overall. You can put it on today and actually save yourself a dime. 303 is where we had it at when we initially put the trade on. But the move up to here is helpful. We really want to get to the top of this channel. So that was a fairly decent move that we gave up from the but it's the end of the candle because we got of the candle. I'm sorry, 368. So that was 6 points higher. So that trade would have been doing well there too. All right. And then lastly, if we look at our trades, we also we looked at uh, calendar spread in UNH because UNH is going, let's go back to the charts. They're going to be announcing, make sure I get it right this time. 10/28 is when they're going to be announcing earnings. So we looked at, and the profit and loss calculator isn't really drawing the graph that well this morning, but UNH, we have the 31st and the 10th. And so if we go back to the what if calculator, we have the 31st and the 10th, 370 strike, buy one, sell one. And then I think we also looked at potentially moving this out. If you wanted to not do the first expiration, which is the 10th, which is this week, let's put UNH in here. And that's right here. 370 and 370. So we're up a little bit on the trade. I think this trade was trading for 11. I kind of remember it's showing me 1103. Does anybody agree with that? Well, the target price, Ray is asking, what are the target prices? If I'm doing the calendars, you want it to go to the strike. Now, ideally, it slowly goes to that strike, and it gets there by that expiration date. But the way that a calendar spread works, and this is why we set the this UNH trade up, is as expiration of, or as the earnings date approaches, which is the 28th of October, you expect the implied volatility of this option contract to increase. So we're paying up for it because we are already paying inflated implied volatility, but we're trying to pay for that by selling a shorter term option that's going to have a large rate of time decay, and you would expect implied volatility to go down. Doesn't necessarily have to, but it's all about the time decay on the shorter term option. So on the shorter term option on the 370, we got $2.80 here, and we can actually roll this to the October 17th if we would like. So we got a couple of opportunities to try to bring in some premium on the short term, but ideally we just want to be long the call. So when you're long a call, if you think about it, once this option expires, as expiration approaches, we are long a call option in October. So the front month expires, then you're long a call. What do you want to happen to implied volatility? You want it to go up. So what we're trying to do is offset some of the extra premium that we paid for that call. And the way that we're doing it is by selling shorter term options. Now, if the market comes up and hits our strike prior to that earnings report, well, we're just going to get out of the trade, because what can happen on shorter term options is if they go in the money, they're going to move quicker. They're going to pick up gamma. They're going to pick up delta faster than the longer term options. And that's the downside of doing a calendar spread. That's the concern that's with it. So right now we have this position on. It looks like we're up about $1 on the trade on UNH. And that's probably because if we look at the chart, well, when did we put this? Where was the market at when we put this one on? 361.25. All right, so we're just getting some good time decay on this shorter term option, because this is trading now for $11.46 and we put it on for $11. Market hasn't moved very much and we're up 46 cents on it. Stay the course. If this front term options expires, it's got $2.55 worth of premium in it. If we get lower than that, if we get down, we could even look at it if it's at like $1. or so, or below that, we can buy to close it and we can roll it out to the next expiration. We can either go to the October 17th expiration or the 24th. But I prefer doing the October 17th expiration. I'd like to give myself a little bit of buffer before we head into that earnings report, because you never quite know what's going to happen as earnings approaches with the underlying stock. So we'd like to stock to drift. The chart looks pretty good. It looks like it really wants to fill this gap, but man, it's sure taking its time to get there. This is a fairly decent consolidation period right within that gap. And we had to break up to this, and we just didn't quite keep going. So that's the ideal scenario, is that we end up filling the gap. If it takes a little bit of time, that's all right. We sold some options against it, and if they decay, that means ultimately when earnings happens, we're long this call option or long the 70 call option with the earnings date at a very reasonable price, right? Because we're going to capture at least $3 or $4 or maybe even $5 from selling shorter term options against it. So it is, and the concept, I guess you could compare it to just like buying the stock and selling a covered call against it because of earnings, because you want time decay to happen. It's a similar trade to that in that aspect. We haven't done a lot of time spreads, but I only do them around earnings. So it's counterintuitive, because a lot of people will think that if they're just thinking in general about options, you want to buy options in periods of low volatility and sell options in period of high volatility. But I don't necessarily feel that way. I mean, the way that if it's a known event, it's going to be priced accordingly. And the one major known event that happens once a quarter is earnings. So we know that because of earnings, we're going to get a pumped up and implied volatility. And that's one of the battles about buying option contracts, is dealing with where volatility is going to next. And this is the one time that volatility is going to increase because of a known event. Now, I like to buy options and in particular, even long straddles on stocks that might get blindsided by news. And I use the Boeing example, or ExxonMobil when they're trying to cap the wells. There was news that was coming out left and right about the underlying. Even Tesla with recently with the Elon Musk and what was happening in his political stance. Like, things were happening with Tesla, not based off of Tesla at all, but news that was coming out of Washington and headlines that were going along with that. So those are underlying stocks that I wouldn't mind buying, because I think that there's going to be a pop in volatility. In this instance, we know it. We're going to sell some premium on the short term, and we're going to buy the option contract that we think the implied volatility is going to go up to. So in this instance, you're looking at the 370 strike. Now, Ray, if you want to on this, let's set up another trade today in UNH. And what we're going to do is we're going to buy the 370 on the long term, and we're going to sell some out of the money premium, because I don't mind this scenario either, in that here's what a long call spread would look like. And this is what this show is all about, is talking about different strategies within the playbook and when you might want to use them. Okay, so we're long the 70, we're short the 10-10-70. Okay, if we were to just do a long call spread, right, 370 would probably go 390. We're looking at a 30 delta. We might even do this one. Yeah, let's do the 385. Let's do the 385. Getting a lot of premium because there's so much volatility that's been added to the underlying, and the fact that it's a $360 stock. So this would be a very viable trade that someone might put together just going into earnings, just a long call spread going into the earnings in October. So we're paying $5. Our break even would be $3.75. I love that it grabbed $5 exactly. And our target would be $3.80, which is feasible. You look at the delta, there's a 33% chance based off of the delta that this that the underlying could finish at least 1 cent in the money, making this, at its max profitability at expiration. So then you would pay $5 with the potential to make the trade for 15, meaning that you could be up 10. Not a bad trade at all. All right. So we're going to send that to the what if calculator. Now, here's how I like to adjust it around earnings. All right. We need to move. There it goes. So we're not going to do what you would call a calendar spread. We're going to do what you call a diagonal spread, or, sometimes a calendar spread is called a horizontal spread. And it's because if you look at the way the quotes are across the top, if you use the same strike, you're going horizontally across the quotes. If you're thinking down on the trading floor of the Chicago Board Option Exchange, to get a quote, you look horizontally at the quotes because they're at the same strikes, but just different expirations. So now we're going to look at a diagonal spread, which means that you're going to buy one option contract with one expiration, and then you're going to go diagonally to a different expiration, and you're going to sell that option contract. But I feel like I'm completely froze. This doesn't usually happen when we're just in the stocks. All right, come back out. Let's come back out. Let me try to fix this scenario. And what we're going to do on my with this trade then is we're going to sell that same strike, but we're going to sell the medium term option, the October 17th strike option. And then if we get to the short strike, we don't have to deal with it as much, if you will. So in that instance, we're going to say no. And in that instance, let me see if I can get this to the what if calculator, and then I'm going to adjust it. All right, now I'm moving a little bit. Let's stay here. Don't let me get there. Just the October 17th. So now I'm going to remove this one, and I'm going to add the October 17th expiration, 385, and we'll sell that one. And we'll send that one to the what if calculator. Okay, I think I'm set. Now we're moving. All of a sudden we decided to start working. So back to the what if calculator, Tradier Pro. Okay. So here is the normal bull call spread. And I'll send that one to ticket, I guess. We're going to put that in here and send that to ticket. So that is trading for $5.94. So this one's going to be a little bit more expensive because we're not going to get quite as much premium on the shorter term option, but we're buying the 370 just out of the money, and we're buying the 385. It's gonna this expiration date is after the earnings. Solid trade, paying $5. $5 is your max risk. Max upside is $10. Now, if we do the vertical spread here, I am going to use the October 30th expiration. The 31st is the option that we're going to buy. And then the short-term option, we're going to look at there it is. All right. We're going to look at the 385 strike with the October 17th expiration. Now, that's a much lower priced spread overall. You're getting $2.37 for that option contract. But if the market goes up, you have that ability to stay in the trade. You can close it because you're going to make a lot more off of the 370 call than you are off of the 285 call. So if you're doing this trade, then I'm definitely looking to roll, right? In that if it gets up towards 370 or 380 or 385, if that does happen, then we're going to sell this position against it. We got $2.37. We hope that expires worthless. And then if we go look at right now, we'll look at the chain. and that's 230. Let's see what happens if we look at the 224-day expiration, 85, and that's trading for 425. So you give yourself the upside. You don't have to get out of the trade early per se, because you're going to get the time decay on the shorter term option contract. You could ride the long call option right into earnings. You have two different chances to sell the call, and this is a diagonal spread call. So let's go back to the beginning. We'll go real quick and review this. As opposed to doing the time spread in UNH, where we're looking for the market to go to 370 and just stop, and we're probably going to get out of that trade prior to the earnings date. If the market goes right to our strike, we should make a couple of dollars on the trade. We get out of the trade. This trade, where we look at adjusting it and creating what's called a diagonal spread, we're long the deeper in the money option. We're going to sell an out of the money option contract. So in that instance, we're selling 385 with the October 17th expiration. The whole goal is that this expires worthless, and this implied volatility on this option contract increases. So this goes up in cost, this decays in cost, and I get a cheap long option at 370. Now, if the market goes down, you just got to get out of the trade. There's nothing you do on the downside of it. But if we can get the market to continue to drift up, we can sell this. Now, if this expires worthless, we can go out and sell another one, because we got one more expiration. And our next expiration would then be the October 24th expiration. And on the diagonal spread, I don't mind that at all, as long as you're giving yourself more potential upside, because you're buying because you're selling an option contract that is further out of the money than the one that you're buying, right? So in that instance, if the market were to run to 385, we'd still be all right. That would be a great move on it, because we'd be making a ton on our October 31st contract with the 370. All right. So in that instance, our target would be the 385. We would want the market to go to that level. That's the range that we are looking for. Now, if we get a couple of things at time decay, well, then you got to decide to yourself, do I want to remain long the call option going into the report, or do I want to take the position off prior to the report? And that's a bigger decision. And UNH, I don't mind being in that trade. Obviously, there's been news headlines that have rocked the stock, and it has to do just with the way that they're doing their books and Medicare and stuff like that. We had Warren Buffett come in by $1.6 billion over the last couple of quarters of the underlying stock, and you've got a lot of options. You got a lot of the insiders that are actually buying it by looking at the volume from the insiders in the chart. So I don't mind being long just going into earnings, but I don't want to pay this type of premium. I don't want to pay $14 for an out of the money option. So this is one way that we can do that position. And then if we want to, we can even sell one more, right? We could you can sell the 17th, you could sell the 24th, and then you could come in and actually roll into the 31st. And you could sell a way out of the money option contract on October 31st. On that expiration, if you would like. So very, very planning approach to how to get long a call option heading into our earnings on a stock that you like, as far as the underlying is concerned. And I do like UNH. We've done a lot of open wing butterflies. We've done really well in this underlying, actually. We haven't had that many that have actually gone against us in this position. All right. Any other questions that we have on the trade? So we got an interesting week heading into earnings. We'll start doing a few bit more earnings trades too. Goldman Sachs is now at 800. So yeah, we needed to get out of that trade. We had excellent timing on that discussion, I guess. So now where is the calendar trading at? Let's send that one to the ticket. No, it's still at $11. Interesting. $7.95. All right. So if you're in that trade, you definitely want to get out on Goldman, especially now that the stock is at 800. if we paid on the Goldman trade, you just don't want this. But yeah, we paid $10 for it. You're up 82 cents. Now it's 55 cents. But if you just don't want this short option contract to pick up steam and take away any gains that you had on the 795 strike. So the fact that it's at 800, you need to do something with this trade. So either you roll the 795, and you would probably roll that up to the 805 maybe at this point, of the next week out, which you're going to probably have to pay a debit for, or you just close the trade. And that's what I would do, is just close. I would have closed the trade when it hit 795. That's simple. Any questions about that? I don't see any in there. Good morning to you, Kurt. Sorry that I didn't grab that one earlier. Appreciate it. I guess we'll call that a day. We're right at time. So Goldman Sachs, UNH, these are the trades we're going to look at over the week. And, those earning reports are going to happen quickly. So thanks for stopping in. I will be back this Wednesday for the next edition of Options Guy TV. And then on Friday, I will be away. So I'm going to actually, the presentation that we just did today, I'm going to try to grab some of the trades and put a PowerPoint together and make it an educational piece for Friday. So thanks for stopping in, and we'll see you at 11 a.m. Eastern Time for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.